Hey guys, welcome back to Jesse Invests. Welcome back. If you are a subscriber, you are a success seeker, I appreciate you coming back. If you are new to the channel, hit that like button down below, that subscribe button down below. I appreciate it. It helps me out more than you can imagine. So today we're going to be diving into Fire 5, the 5 fundamentals for a fire stock. This is my way of picking a stock. This is how I choose my stocks and how I highly suggest you would too. This is how you get winners in your portfolio, not bumhead stocks that are just going to tank and make you regret your decisions and question your life choices. So first off, we're going to start by just taking a quick look at my portfolio so far. A little bit of a mini update here. We're up 18%. $29 of that is dividends, and 161 of that is just the gain of the stocks. We're looking at every section up, with the restaurants in the lead next to industrials, and bonds and my growth kind of staying around the same. And yeah, we're in a pretty good spot with those. So let's jump right in to rule 0 of the Fire 5, the 5 fundamentals. If you follow this Fire 5, you should be able to tell if a stock is a winner within 10 minutes, less than 10 minutes, 5 minutes, and you will be able to figure it out. So rule number 0, before I even get into the 5, is don't pick stocks. Might seem like, what are you talking about? Maybe don't pick stocks. That's why I'm here. That's why I'm watching this video. I get it. But if you can invest in VU, SPY, or an ETF that just tracks the S&P 500, it's automatically adjusting the portfolio behind the scenes for you to invest only in the best top 500 performing stocks in the S&P 500 in the stock market. And it's been proven to give you 9 to 10% returns every single year since, and on an annual basis, since like the 1900s, since over 100 years ago. So I personally invest over 75% of my investments in VU or a similar S&P 500 tracking ETF, and I spend less than 30% of my investments on individual picks, just kind of for fun, to kind of see, oh, will we beat the market? Will we get close? What would that look like? Just to have some personal connection into it, to scratch that itch, if you will. So if you can avoid it, buying personal stocks picks, I would. Rule number 1 is understanding anecdotal. Understand the value it brings, know how it works. So when I pick a stock, I like to make sure that I understand how the company works. Do I understand the value it brings? Do I know how it works? Do I like it? Do I like it? Like, let's say, for example, Texas Roadhouse, right? Let's go to my holdings. These are the stocks that I have, right? I have jepi, schd, Apple, Texas Roadhouse, John Deere, I have Caterpillar, Kroger, Waste Management, MasterCard, McDonald's, JPM, Microsoft, Target, Hershey, and a couple of ETFs like Van Eck, Costco, Aflac. I can tell you how any of these individual positions work. I can tell you why I like them. I can tell you how I have a personal connection with them. For example, let's go to Texas Roadhouse. I eat at Texas Roadhouse like every other week. Every time I go, they're packed. They got a line out the door. That's an hour wait if you don't RSVP. You've got a full parking lot. It could be a Monday night, Saturday night, doesn't matter. I can see that they are always popping. Long story short is Texas Roadhouse I invest in because I like the company, I like where it's going, but also because I like it. I eat there. I personally have an attachment to the products they offer. I just understand it. If I was down 5%, which I previously have been down on Texas Roadhouse, you know what I did? I bought more. I didn't sell. I held on and bought more. But I don't think that would have been possible if I invested in a company that I didn't really care for. So don't invest in a company because everybody's buying it, because everybody says, oh, it's just buy it just because it's good. You want to make sure you actually like the company, because then when it's going south, you have an extra attachment, a little extra faith in the company. So when Texas Roadhouse was down, I still saw the stores filled up with people. I still saw the hustling and bustling. I saw them making money. So I knew it's only a matter of time until it goes back up. They're doing something right. They're doing something right. Rule number 2, guys, is you want a basic technical analysis. Now, you can get real deep into this as you grow in your knowledge of the stock market if you care to. I like to keep it simple. I just check 3 things. I like to look for growth in 3 areas: revenue, buybacks, and EPS growth. So let's go take a look at what that looks like. So if we go to Caterpillar here, one of the stocks I invest in, we can look at revenue. This is the amount of money that they are making. This is like sales, the money they're bringing in. We can see that since 2020, I invested here in at about 2023. But since 2020, they have been going up in revenue, up. For 4 years straight, they have been going up in revenue. Look at that. That's great. That's a good sign. So they're doing something right. They're making more and more money. They're increasing the amount of revenue that they have. That's a good sign. Versus, let's take an example of something that's not great. And I'm going to be using this for a lot of examples here on this video. But we could take CWH. Let's go ahead and take off cap. This is the revenue of Camping World. We can see for the last 3 years that they have been kind of stale or going down in revenue. They're making less money over time. That is a red flag. It's not something you want to be putting your money in. And then we look at buybacks. So if we go to, let's go shares outstanding, and we go to, okay, let's go to Camping World, right? This is the amount of shares in the market for Camping World. It's kind of the same, kind of stagnant. They're not diluting the shares, but they're not decreasing the amount on the market. But if we go to something like, let's do Microsoft. I believe they have a buyback. Yep, bingo. This is down, and it's good if it's down. I think with less shares on the market is more scarcity. Your share is worth more. If they add a bunch of more shares on the market, your share is diluted. It's not worth as much anymore. So we can see that Microsoft in 2009 had 8 million shares on the market, and now in 2023 they have 7 million. So they've year by year been decreasing the amount of shares they have on the market. So now you have, if you own a share in Microsoft, you have 1 of 7 million instead of 1 in 8 million. So eventually that'll become 5 million, then 3 million, then 2 million, then 100,000, 10,000, 1,000, 100. You know, ideally, in a perfect world, it goes down to 100 shares, and then that one share you bought when there was a million of them is now 1 in 10, and that's so valuable because you have 10% of the company. So you want to look for shares that are decreasing. Shares outstanding that are decreasing means they have a good buyback program, and that's something I like to look for. And then let's look at EPS growth. Let's go ahead and go to Google for this example. Let's go to EPS. Earnings per share. This is a great sign. You want it to be going up. A good company is going to be earning more and more money per share as time goes on. We can see that for the last 2 years, they've been going straight up, and then they really took off starting in 2020. Had a little bit of a correction here, but they're, over time, even since 2009, slowly increasing in earnings per share. They really shot up post-2020, though. So like another example of this not being good is, let's check Camping World Holdings, which I used to own. I'm using this example. It's not the world's worst stock. This is a serious stock that investors buy. I mean, I bought it recently, like last year, until I realized it was not the best investment and sold out once I started doing analyses like these. So Camping World, we can see its earnings per share is kind of stale. Since 2016 for 8 years. It's flat, down. Starts to go up. If you invest around 2019, 2020, I can see why you think, oh, it's a redemption for this. See, look at that chart going up. But then we hit a plateau about 2021 after only 1 year of rising and going down ever since. You want to get a stock that's earning more and more per share as time goes on. That's technical analysis. So the next five fundamentals, next other 5 fundamentals are number 3, dividend. Does it pay a dividend? And if it does, is it growing at a pace that's beating inflation? And is it a low % of their earnings? And do they have a long history of paying? You want no chance that this dividend is going to go anywhere. This is a good dividend stock, and here's why. This is their dividend payout chart. You can see that it's been on an upward trend for years. That's great. There's also no dips. There's no cuts in here. We could see that the payout ratio, they pay out only 50% of their earnings towards the dividend. So they're in a stable position to continue to pay it. We can see that, let's see here, that they've paid it for 45 years. That means they have paid this dividend and kept it going and rising for 45 years. That's a great sign. It means it's not going anywhere anytime soon. And then we can see DGR3 is the growth of that dividend in the last 3 years, 5 years, 10 years, and 20 years is 11, 15, 15, and 22. Which means the bare minimum, it has been going up by 11% a year, the dividend, not the stock. Inflation is 3 to 4%. So 11% per year growth in that dividend means your dividend will grow faster than inflation can grow. So you will be over time earning more and more and more money with that dividend. That is a good stock as far as dividend goes. Completely checks off number 3 off that list, dividend. Now let's go to one that does not. CWH. Again, I'm beating on CWH today. It has 192% of its payout. Big red flag. It's paying more money in its dividend than it can actually afford to. And we can see that it has paid for only 9 years. Definitely not as long as the other ones. That could be a bad sign. And take a look at this dividend payout chart. In 2010, 2011, they paid 50 cents dividend, but then they slashed it to 25. They cut the dividend in half, kept that going for 3 years, and then there was a period of no dividend for 2 years. They brought back the dividend, and then it was growing. Everything looked good until they slashed it. They cut it down by over 80% in 2023. That was the first red flag for me to get out. I only had like 4 shares, but like $100 in it. But when I realized that dividend got cut, I was like, oh, that's not a good sign. We can see right here, they dropped the dividend by over 80% in 2023. Why? Because they're paying out 192% of their money to the dividend. They can't actually afford to pay the dividend, which does not tell you very good things about the fundamentals of the company. So I got out, wouldn't recommend that. You want to make sure it's paying a strong dividend that has a history, that beats inflation, is a low percent of their earnings so they can afford it, so it has no chance of getting cut. Last but not least, guys, number 4 is the chart. This is super simple, but some people just, you'd be surprised, do not look at this. Is the chart of the stock good? So let's go to Texas Roadhouse here. I like to look at 1 year and beyond. Up in the past 1 year. Green and up in the past 5 years. Green and up in the past max time. This is great. Good chart. It's showing that it is going up even with dips like this dip in 2020 and this dip in 2021. It's showing over time it is still rising. That is good. An example that is not good with this is going to be General Electric. I'm going to hate on General Electric, guys. I'm sure I'll have someone in the comment that's a holder and is going to hate on me for doing this. Last year, up 100%. That looks great. Look at that chart. Wow, that looks great, right? But 5 years, also up, great. Max time. This is where the red flag is. It looks great until you look at the max time. We could see in 2000 it was 300. It went all the way down and then down. It fell, and it looks like it corrected itself. It looks like everything's good for like 6-7 years straight until it went down again, and now it's up. If you look at the past 5 years, almost like a great company to invest in. Look at its history. It has gone up over time before and fell. Gone up right here and fell. It was up here and fell. It could go up all the way up here by where my cursor is, and it could fall again. So a buddy of mine invested in General Electric, and I told him I don't really like all the blood red we're seeing in the max time. That's not a good return. 40% on your money if you invested back in 2000. That's not great. So last but not least is going to be number 5, proven time-tested big name winners. This is super simple as well as like looking at the chart. I like to invest in high market cap stocks. I think it's a good idea to invest in stocks that are big name winners, that are time-tested, that are household names, that are just big. If we go back to my M1, we can see all of these names are household. Well, almost all. Everybody knows what Aflac is. It's insurance. Costco is a grocery store. SMH is semiconductors, and you might not know what that is, but you'd see that they invest in like microchips, and everybody knows what a microchip is. Hershey, Target, Microsoft, Chase Bank, McDonald's, MasterCard, Waste Management, it's trash. Kroger, Caterpillar, John Deere's, Tractors, Texas Roadhouse, Apple. I don't have, Biogen Zayden Pharmaceuticals. Like, I don't have small companies or startups or could go anywhere companies. I like to invest in known, proven, time-tested market names like Apple, Microsoft, ones that have been around, aren't going anywhere, have a big history behind them and a future ahead of them. And yeah, guys, just a disclaimer, there's a lot of ways to analyze and pick your stocks. People are probably going to suggest, oh, well, you didn't say this, you didn't say that. Everybody has a different way of picking their stocks, but I did have a comment asking me how I picked mine, and this is how I chose mine and how I will continue to choose mine. I need to have anecdotal evidence. I need to have a basic technical analysis of their revenue buybacks and EPS growth. I like to check their dividend to see if it's not going anywhere. I like to see a good chart covered in green in the last 1, 5, and 10 years and max time. And I'd like to see proven time-tested big name winners, just like staple champion dividend gods. So, yeah. Don't forget to like, subscribe. It means a lot. Appreciate it, guys.